Do you agree with Jeremy Siegel that this is the most dovish Fed chair of our memory?
Sounds to me that way. And not only that, though, you see the VIX, the volatility index, is back down to where it was pre-pandemic, which is actually dangerous because it means that, people are very, very optimistic. And Tyler, you've been in this business a long time. When people say, well, I expect a lot of volatility in the future, that's because we've had volatility in the past recently. Now people don't expect much volatility. And so the VIX is very low. And so that and the Fed being so dovish is a little bit of a warning sign as euphoria is building. I agree.
And so, Quincy, let me pick up on that point that Andrew just made. Not only do you have the VIX coming back to rather tepid levels, but you also have that AAII index or reading at the highest level of bullishness in several years, at least 3 years or thereabouts. And the difference, the gap between bulls and bears is very wide. Is this something to worry about? Because typically when that's happened, it augurs something not so good.
Well, you also have the credit spreads are nice and tight. Credit default swaps are indicating a solid, robust backdrop for the economy and the market. So, yeah, it is something to worry about because you worry about too much liquidity. You worry that perhaps there is another fund, whether it's a family/hedge fund, that has taken on too much debt and gets a margin call. And the derivatives aren't working the way they were supposed to work. There's an old expression from the market where there's one cockroach, there are many. And, we saw what happened last week, the week before. We could see more. And that's always the concern in the market, is that you build up and, you're successful, you keep going at it, and then ultimately something comes along to change the thesis. And regarding the VIX, we've been waiting for it to come down below 20 and stay below 20. This is also very important in terms of the mindset of the market.
Before I turn back to Andrew to pick up on something that I find very interesting in his commentary, I want to ask you this. So, in other words, if you have a worry, Quincy, it's not because you're worried about any fundamental issue. You don't seem to be worried about the economy, about corporate profits, about what the Fed is going to do. You're worried about some unknown, some exogenous factor getting in the way here. Am I reading you right?
Well, yes, exactly. And even, we have the Fed ultra dovish because it has in essence, a new mandate. They broadened the maximum employment mandate. And that's new. So we have to worry in some way about their framework, their timetable. And then the question becomes, when do they, with their glide path, begin to talk about the potential for tapering those monthly purchases? That also is something that's out there. This all works if everything stays the same, rates stay low. We have largesse from the fiscal side, ultra dovishness. If something comes in and changes this calculus and equation, margin calls are going to be next.
Shepard Smith here. Thanks for watching CNBC on YouTube.